The NAB has been trying to make a virtue out of being different from its three other big bank rivals. But interim results posted this week showed it's pretty much in the same boat as everyone else. Its cash earnings were up a solid 6% to $2.8 billion for the half, thanks to trading income. But net profit was down more than 15%. Costs are under control, but margins were crunched and growth slowing, just like the others. I spoke to NAB's chief, Cameron Clyne, right after the results were posted. Well, Cameron Clyne, a lot of analysts I've been talking to say that your big breaking up strategy with the other banks, competing with them really aggressively, hasn't worked. What do you say?
We've had 200 basis points of market share gain in the personal bank and 300 basis points of market share gain in the business bank, and profits are up 6% year on year, and underlying profits up 7% even on the half. So I'd suggest it's working very well.
Well, you obviously sound happy with it, but you kept 18 basis points of the recent rate cut by the Reserve Bank. Doesn't that show that you can't keep pricing as aggressively as you have been?
No, not at all. I think we're very happy with it. It's a long-term transformation for us, obviously, in terms of restoring the Australian franchise. But I think we made our rate decision quite quickly because the RBA had moved by 50, and I think what we saw was a desire from our customers to have certainty. So we just made our rate decision. We reduced by 32. It gave us a nice headline rate of 6.99, which is market leading. I think subsequently a number of competitors moved closer to us, but I think we were first out of the blocks, and I think the more interesting story is the way the competitors moved to us.
Are you going to be able to continue to be the market leader on price?
Oh, look, absolutely. I think it's delivered for us. I mean, we've had very substantial customer gains. We're at a 15-year high in customer satisfaction. I think, when I go back and point out, I mean, we obviously, enjoy the monthly obituaries of the break-up strategy. But if you go back 3.5 years ago, we had a personal bank that was growing well below the system, was attracting very poor quality mortgages, was very low on customer satisfaction. And we had to grow it and grow it strongly, and we had to do it organically because there were no options as it occurred from certainly our major competitors in the Sydney market where there'd been acquisitions. And we've done that. That gives us a wonderful platform with some 650,000 new customers to continue to reform the personal bank. So I think it's been a very good strategy, and the fact that we're able to absorb what's obviously a disappointing result in the UK and still produce what is actually the market-leading pre-provision profit number, I think is a great achievement.
Well, Mark Joyner, your CFO, said this week that the rising cost of funds is going to mean 5 basis points of margin compression every quarter. So isn't that going to crimp you from now on?
Well, it'll crimp everyone. That's the reality. It's a very competitive environment out there. We're all trying to chase asset growth in a weak credit environment, and we're all trying to raise more deposits to strengthen the balance sheet. So we were calling out that, in fact, it has been compressing by about 5 basis points a quarter, and it probably will continue to do so. So I think it's one of the pressures that all the banks are facing.
Are you concerned about house prices? They're down about 6.1% nominal from the peak. Do you think they'll fall much further?
Well, I think our mortgage book actually is showing quite good performance. The irony is that although we've been growing more strongly in recent years, we've been growing into better quality mortgages because we're a far more credible player than we were when we were growing weekly some years ago. But I think the real driver of house price or significant house price falls will be a rise in unemployment. That's the traditional driver of a significant house price decline. So obviously we're not seeing that at the moment. That's not to say it may not occur if the economy remains fragile.
So does that mean you don't think house prices will fall anymore, or that they'll fall a bit?
Well, they may fall slightly, but we're not seeing a precipitous decline at this point, absent potentially rises in unemployment. We're seeing if there is going to be a fall, it'll be fairly moderate. And the economy's been able to absorb the house price decline to this point. Though, I mean, the reality is that house price decline does have an impact on consumer confidence. On
the subject of the economy, what do you think of this week's budget?
Well, I think most budgets are a mixed bag. I think, there's some things in there that may be potentially good for the economy. I think some of the, putting aside what, philosophical issues around where payments should go, some of those payments could potentially be stimulatory to the economy, particularly if they're targeted at sections of the community that are more likely to spend them. There may be some confidence benefits from some of the SME initiatives around accelerated write-downs, but obviously business would have liked to see tax cuts and a range of other things. So I think like most budgets, there's something for everyone, and some people are disappointed as well.
What do you think the outlook for interest rates is?
Look, I think at the moment we're still feeling that, there's probably a few more cuts to come, but, the relatively surprisingly good job numbers today may temper when those cuts come. But I think we're still likely to see, maybe another 50 basis points of cuts over the course of the year, but they may come a little later. But I guess like most people, there's been a lot of predictions on interest rates and a lot of them have been wrong.
Thanks very much, Cameron Clyne.
Thanks, Alan.